All right, good morning, everybody. Thanks so much for being here. We'll go ahead and get started in about 30 seconds.
All right, should we get started here? Okay, hello everybody and welcome to Finance for Non-Financial Professionals During Challenging Times. We know that this was a tough year for everybody, whether it was, financially, personally, or within your business. So we're really excited about this event. We do these community events every Friday, and they're 45-minute workshops. And we usually, whether they're led by one of Learnit's community teams, we'll get somebody internally, one of our instructors, or we'll have a subject matter expert like Frank. We try and split it up within the month, like 2 internally and 2 partners. We usually always feature a nonprofit partner. So whether it's somebody that we work closely, that Learnit works closely with, or if we have a guest speaker, we'll try to, use one of their nonprofit partners that they find close to them. We did how to deliver effective virtual performance reviews on Friday, December 4th. And next Friday, we're doing how to feel confident going into your virtual performance review. So it's kind of a spinoff off the first one. So if you went to the first one or you weren't able to make it, definitely join us next week. We know that the end of the year, there's a lot of performance reviews going on. So we want to make sure everybody is prepared for that. And today's speaker is Frank. He's awesome. He is the founder of F Abbott, which is his own company. He is a course leader at Learnit and at the American Management Association. He is a CPA and a CMA. He has over 20 years of experience in the finance, accounting, and training industry. He is also an active member of the American Society for Training and Development, and he served on the board of directors for the Silicon Valley chapters as chief financial officer. So he has years of experience. He's great. And all of the donations today are going to go to the Canadian Cancer Society. I don't know if Frank wants to speak a little bit more on that. I know that nonprofit is very close to him, but that is where the donations are going today, and we're really excited about that. So I will I will hand it over to Frank, but very quickly, I do want to let you guys know that if you have a coworker that wanted to make it to the session and unfortunately couldn't, all of these sessions will be recorded. We're also streaming live on YouTube right now. So if you have somebody maybe having trouble signing in, it'll be live on YouTube and it will be recorded on our community site offsite later today or on Monday, I believe. So I'll hand it over to Frank and I hope you guys all enjoy.
Thank you, Marissa, and welcome everybody. As Marissa said, one of the organizations I'd like to sponsor, Canadian Cancer Society, and the reason for that is I am a native Canadian. I have been in the US now for a number of years, but being Canadian, there may be some phrases that sound a little strange in our period together. Fortunately, I had some opportunity to see the work of the Cancer Society. My mother, a number of years ago, did come down with small cell lung cancer, and it just very much impressed me that the work they did with the oncology department in the hospital and the other ventures. So it's kind of close to my heart. So welcome everybody. I'm going to pull up my PowerPoint presentation, and then we will get started into that area. So all right, Marissa, can you confirm you're seeing that okay?
Yep, I can see it.
Good. Okay, thank you. All right, we are here today. I want to have a very, very good session to you. And maybe to start it off, what I'd like to do is just ask you a question. Who of you out there has been somewhat impacted by our COVID issue that we are going through? If you just type your check mark, yes or no, be interested to just get some response on that. Okay. It would be interesting if anybody had not been, but so that has been, thank you for the responding. That has been one of the key challenges we've been facing. And when we talk about challenges, they're not necessarily negative. Certainly the COVID issue has been impacted negatively for a number of us in our businesses or personally. Some people could also have been impacted in a more positive area, if you will, because some of the companies that have been providing PPE equipment to our first liners, they have been stressed out in the sense of trying to meet that demand. So one way or the other, there are challenges. And what we're going to be going through today is some opportunities to meet those challenges. So questions to ask, if you will, that we will be hitting today. Are we as profitable as we could be as an organization? What areas of our income statement should we focus on? And I'll be going through there and give you a couple of opportunities to be reviewing your income statement in your business. Do we have any problem collecting cash from our customers? And certainly during this recent period this year and probably moving into 2021, that's going to be another stress point because our customers have been suffering as well. So how do we determine what the problem is and what is the magnitude? If you happen to be product based, we're also going to be looking at inventory. Are we managing that effectively? And then we're also going to talk about an organization's break-even point. I will get into that in a little more detail, but basically your break-even point is if we're product-based, the number of units I need to sell, or if we are service-based, what level of revenue do I need just to break even? And if I can exceed that, then I'm going to be in a positive manner, if you will. So some of the answers we're going to be striving to get a hold of is looking at trends in your income statement. And when I talk about trends, it could mean from last year to this year. It could mean how we are doing compared with some of our industry members. It could also be how we're doing versus our budget or plan. Where did we say we would be? And these will help us indicate some strengths as well as some challenges. Key metrics, how are they calculated? I'm going to walk you through two of them. For receivables, amounts owed by your customers, it's going to be something called Days Sales Outstanding, or DSOs. And we want to understand how this will impact our cash flow in our business. Also in the inventory area, the metric I will walk you through is Days Inventory Outstanding, i.e. how much inventory do we have on the shelves in the warehouse right now that hasn't yet been shipped out. Now, some of you are going to be service-based, but you may be dealing with organizations that are product-based. So I think it's important to understand how their inventory status may impact you. And then I'm going to walk you through the calculation of the break-even point, both in units as well as in dollars. And again, how much you need to sell just to cover your costs. That is my goal today. And my key goal in my business is to assist in educating people in financial issues, financial terms. I also have a small goal, and that goal is to improve the image of us in accounting. I know if I asked you what you feel about your accountant or the accountants in your business, you would probably say, well, they're kind of boring people. They have no sense of humor whatsoever. There's no life outside of their job, and they spend all weekend working on software packages for accounting. Now, that may be the case, but I would like to enhance that image a little bit. And some of the reputations that we have attained over the years, here's an example where we get a bad rap. A woman went to her doctor, and the doctor told her she only had 6 months to live. Oh my God, said the woman, what shall I do? Marry an accountant, suggested the doctor. Why, asked the woman, will that make me live longer? No, replied the doctor, but it sure will seem longer. So what we'd like to do is kind of break through that a little bit. We are nice people. We are nice people. All right, let's get right into it then. Here is a representative income statement, which I would like to walk through with you a bit, and then we're going to bounce off that and look at how can we identify some trends, either positive trends or maybe some negative trends. So this company, their net sales, $2,964,000. Then we have cost of goods sold or cost of services sold. If you are a product-based company organization, you will have cost of goods sold. And what goes in there? Let's use the example of Apple for a minute. Their cost of goods sold would be for the material that goes into their tablets, their smartphones. It would be the direct labor or labor, excuse me, for the folks to actually hands-on make the iPhones, tablets. And then we have something called manufacturing overhead, which would be the cost to run the facility where they're making their product. Things like utilities, excuse me, rent if they're leasing their building. If they own the building where they're making tablets, it would be their depreciation. So those would be the three components, cost of goods sold. If I'm a service-based business, it would be the cost of directly providing the service to your customer. The example of my company, I provide workshops, training workshops to clients like organizations like LearnIt. So my direct costs would be my materials that I have developed. It would be travel, if I did travel, which I have not been doing much this year. That's been my challenge. If I had a couple of employees delivering training, it would be their salaries and benefits. So that would be my direct cost of services. And in this example, that's $797,000. Gross profit, therefore, is the difference, $2,167,000. Operating expenses are the expenses of running your business, but unrelated to making your product or delivering service. And you can see we've developed these by function. We've got our sales effort, our general and administrative, which is kind of the corporate functions, human resources, finance, legal team, and then research if we are developing next generation product. Just as a side issue, if you looked at a couple of the companies now, Pfizer as well as Moderna are very, very close. In fact, they've already started distributing some of the vaccines. You can imagine what that research expense for them has looked like over the last year to get ready for launch. So total operating expenses, $1,415,000. Therefore, our income before taxes, $739,000. If we're a corporation, you would then have your income taxes, of course, and then you would get your resultant net income. If you happen to be set up as a sole proprietor or a partnership, your organization will not have income taxes, but what we would do is take the $739,000, the income before tax, and that in effect would be distributed to you as a sole proprietor or a partnership, and then you would complete your personal income taxes as a source of income. So this is a typical P&L. If you were a direct or a service-based business, you might not show necessarily cost of services. You may group all of your expenses after revenue and just list those, such as salaries of your employees, rent, supplies, etc. So the format for the income statement may be a little bit different, be you a service-based or a product-based. How do we analyze that then? Here is one method. And again, we're looking to analyze it to indicate any pain points we may be facing from challenges and also some stress points moving forward. So we've got our net sales, and these numbers are what we just saw momentarily. I then on the right-hand side have a percent column. We start with sales as 100%. And I'm then going to take every line item and compare it to sales. So I'm going to get my cost of goods sold, $797. I'm going to divide it by sales, and I get 26.9%. My gross profit, therefore, is 73.1% of sales. What does this translate to? If for every dollar of sales in my business, after I take care of the cost of making the product or delivering service, I'm left with 73 cents. This percentage is sometimes referred to as your gross margin. It tells you how profitable your sales are. So after I take care of making the product or delivering service, I'm left with 73 cents. What can I use that 73 cents for? I then can use that to cover my selling expenses, my general administrative, and my research. They total 47.7% of sales. Income before taxes, 25 cents, taxes at 5 cents. So bottom line, and this 19.7% is also referred to as your profit margin. What this says is for every dollar of sales, After I cover all expenses of doing business, I'm left with 20 cents. Here's what companies are probably doing right now this year. This could have been their original budget as an example. So most likely many companies have been facing a drop in sales. If you think of the restaurant industry, they've had a tremendous drop in the revenue just because of the issue of reducing the number of patrons, closing down in certain areas. So they are probably looking to say, all right, my sales are still going to be 100%, but my expenses may be a higher percent of sales. Therefore, my net income as a percent of sales may be dropping significantly. So this vertical analysis gives you an opportunity. And for 2021, most companies already have started to put their budgets together for 2021 and maybe 2022. And they're going to be forecasting some of these metrics. Given the experience in 2020, where do I feel my selling expenses will be as a percent of sales, research, et cetera. So it's a very powerful technique either to analyze your current income statement and also project forward, factoring in our assumptions on that. Okay, so that's
Frank,
a vertical. Yes, certainly.
I think we have a question.
Okay.
Peter asked, how is the calculation of the income before taxes performed?
Good question. That is mathematical. I will take the 73.1%. I deduct the total operating expenses of 47.7, and that will get me 25.4%. Another way of doing that, Peter, and it will give you the same number, I hope. I could take my income before taxes of 739,000. I would divide that by sales of 2,964,000, multiply by 100 to convert to a percent, you would get the 25.4. So you can just start adding, subtracting as you go down the percent column, or take each line item, divide by sales, multiply by 100. Okay. Thanks, Peter. Appreciate that. That's your vertical analysis. We also have another methodology, and it's called horizontal analysis. It's a little busy schedule, but let me walk you through it. This is the same income statement, and there's your 2019 numbers. I then have plotted in my last year, 2018. Then I have a column called change. Now that's the change from 2018 to 2019. So for example, my sales have gone up from last year, $470,000. I want to express that as a percent of last year. So I would take the 470,000, divide by the 2,494 sales, multiply it by 100, and over to the right, you can see I've got 18.8%. In other words, my sales have gone up 18% from last year. I do the same thing for each line item. Let's just take cost of goods sold, cost of services. They went up 29% from last year. Therefore, my gross profit grew, it looks pretty healthy, 15.5%. But here's the thing that will start to kick out a pain point for you. If my sales went up 18%, the cost of the products I sold or the services I sold went up 29%. So my gross profit only went up 15%. That could tell us there's some issue in cost of goods sold. Maybe my material price went up significantly. Maybe the salaries went up in my manufacturing area more than I anticipated. What we would like to do over time, whatever my sales growth is, here 18%, I would like my cost of goods sold, cost of services to go up no more than that. I would like a sales ramp up to fall right down to the gross profit line. This looks like it's a trend I would need to look at. Similarly with our operating expenses, supporting the business, look at selling. It went up 38% from last year. Now that's not necessarily bad. We may be in expecting higher sales next year. I may have to add some sales force. I may have to add a sales office. So it's not necessarily bad, but it is showing you a trend. Research went up 21%. Again, if we're looking at our Pfizer's, Moderna, Johnson & Johnson on the vaccines, that probably has gone up significantly this year for them. So my operating expenses are up 22%. Therefore, my income before taxes went up only 4%. My income taxes went up a bit. So bottom line profit, I am up 3%. But look at what our sales were up 18%. And by the time we get down to the bottom, we're only up 3%. Once again, as a sign of health, I would like over time, whatever our sales growth is, I would like that to fall to the bottom line. There will be reasons for it, but that would be one trend to take a look at. Are you getting the benefit of any sales increase? Now on the offside or the opposite side, because of our challenge with COVID and maybe other challenges within the business, we may have had a drop in sales. And that's very likely in many, many businesses. I would like to see where I could control my costs so that a drop in net income percent-wise would not be greater than that drop in sales, if you will. So I always take these metrics below, comparing them up to your sales change, either a percent increase or a percent decrease. So next year, again, we could start projecting and saying, how do we anticipate 2020 sales or 2021 sales expenses, and see how that will compare to 2020. And companies, of course, are vigorously looking at that right now, and they're making certain assumptions as to when do I think I can get my revenue up? How am I going to control my costs next year as well? I may have to increase certain costs. I've got to bring back some of my employees. So I would suggest to you there's a fair amount of analysis now being done on 2021 and 2022. Okay. Any questions on that to date, Marissa, that might be coming in?
Nope, we're all good right now.
Okay, thank you. That then is horizontal analysis. So let me go back. Two of your tools to review your income statement would be the vertical analysis, taking each line item as a percent of sales. Horizontal analysis looks year to year. It could also be quarter to quarter. I would imagine, again, during 2019, companies are even looking month to month. What's been the change for the month, and what can we do to react to that? All righty, a little interlude here, back to our accounting reputation. So an accountant goes to see his doctor, her doctor, and they're having a hard time sleeping. Doctor, I just can't get to sleep at night. Well, have you tried counting sheep? That seems to work for some people. Well, that's a problem. I make a mistake in counting them, and then I have to spend 3 hours trying to find it. We in finance have to tie everything down to the penny. So again, we're a little bit more than that. Okay, I want to move into two metrics I alluded to earlier. I want to look at your receivables. How effectively are we managing our receivables? And then after this, we'll look at how effectively we're managing our accounts payable, our supply stuff. So the term is called DSOs, Days Sales Outstanding. It answers the following question. How many days from the time you shipped your product until you got paid by customer? If we're service-based, it's how many days does it take from when I complete the service until I get paid? So personal example, at the end of a workshop, I've done a couple workshops with Learn It over the past while. And when I've completed my service, I send Carly my invoice, and then she, excuse me, she works that through her system to pay me. And I'm hoping to get that in 15, 16 days, Carly. And I know each company will have their policy as to what their payment term is. So I can monitor the monies owed by Learn It and a couple of other my partners to kind of keep on top of my cash position. Here's how you calculate it. We take your average accounts receivable. So I might take my receivables at the end of last year and my receivables at the end of this year and average them. And the reason I suggest maybe averaging them, you may have a spike in your receivables, and your receivables, of course, are representing what's owed by your customers. So that could go up and down during the year. I may want to average that. And I'm going to divide that by sales per day. So just below, our average receivables were 9,900,000. I had annual sales of 100 million. I wish that was, these are not the numbers in my training business. Please believe me. I wish they were. So my sales per day would be 100 million divided by 365, or 274,000 per day. So each day I am generating 274,000 sales. My DSO, day sales outstanding, I take the 9,900,000 divided by my total sales, and I get, divided by my sales per day, and I get 36 days. This means it's taking me 36 days to get paid by customer. And if I asked you, do you want that up or down? I would suggest you probably want that down. This metric, certainly I want to look at my company overall, but I can also do this calculation for individual customers because I can get the receivables from each customer. I can get the sales to each customer, therefore I can get the sales per day. So I can get the day sales outstanding for each of my customers. So I can do this for Learnit as an example. If I have a number of invoices outstanding, I can look at the receivables from Learnit. I can look at the sales I provided to Learnit, and I can track the DSO. And I want to track this probably on a monthly basis. So if I can pull out my 3 or 4 major customers, I can see how the trend is. And if your DSO is going up period to period, that raises another question, maybe a pain point. I may have conversations with my customers. They may be having financial difficulty. And again, with the COVID issue, I would imagine most companies who are selling products or services are experiencing a higher DSO. Our customers are in financial difficulties. They may have to push off paying us somewhat, or maybe not pay us 100%. So this is another challenge for companies, because as my DSO gets larger and larger, that puts negative pressure on my cash flow. I'm not able to get the cash in quick enough. And I may in turn have to put pressure on my suppliers. I may not be able to meet payroll, or I may have to go out and get some short-term loans in order to keep me fairly liquid during this challenging period. So DSO is a wonderful metric to monitor over time, as well as individual customers. So if you can work with DSOs, I think you would find that quite helpful for you. DSO is one way of measuring our customer activity. There is another metric or a methodology. It's called aging of our receivables. It's a little busy schedule, but I will walk us through it. So here in this company, our total receivables are 7,323,000. I have broken that down by my customers. This company has 5 customers, as you can see. And under the total, that is the total amount owed by those customers. I then want to age it. Well, what do I mean by aging? If I have an invoice, I want to determine how old that is. Now, again, these numbers, these amounts have not yet been paid by customers. This is what's outstanding. So I want to look at that and say, well, how old is that stuff? Well, for customer A, 2,000,003 is very, very current, i.e. it is due no more than 30 days from now. So it's pretty current. Part of the receivables is a little older. It's somewhere between 31 and 60 days. 61 to 90. And then I've got some amounts from customer A that they haven't paid in more than 3 months. It's sitting out there as greater than 3 months. And similarly, you can see for all the other customers. So at the bottom, I've got all of my customers broken down between their age category. And then I take that as a percent of total. So I have 4,009,000, 0 to 30. I divide that by my total receivables and I get 67%. What does that mean? 67% of my accounts are quite current. 21% of my accounts are much older, 31 to 60 days, still outstanding. Look at 61 to 90. 35%, 36% of my Receivables are older than 2 months, stretching to 3 months. And I've got 3.9% that are very, very old. What a company will do is use this aging analysis, and history of your company will tell you. First of all, broad-based statement, the older the account, the less likely you are in collecting it. And you can do some analysis of your collection activity and come up and say, Frank, if my accounts get older than 90 days, I'm not going to get that. I'm going to have to write that off. Now, when your finance person says we have a write-off or have to have a write-off, that means immediately I've got to take a expense charge against profits. And let's assume this company determined they need to write off $285,000. Let me go back to the income statement momentarily. If they have to write off $285,000, then they're going to incur an expense that year of that amount, and that will reduce their profitability. So it hits our profitability significantly if our accounts are getting pretty old and I face write-offs. The other thing it's doing, obviously, is negatively impacting our cash position. I'm not getting that $285,000 in cash, and I have already put monies out to suppliers to buy their products, or I have put it out to my employees who are delivering the service, or I put it out to my landlord in rent, and I'm not getting that cash back. So any write-off, when you hear the term write-off, please right away say, whoa, that's hitting my profits, and it's holding up and I'm never going to get that cash. The aging analysis would also allow you to maybe talk to a couple of your customers. For instance, look at customer C. They have 200,000, 61 to 90 days. They have 200,000 over 90. So they've got $400,000 of my cash over 2 months. I'm going to have a phone call with them, or maybe even a personal visit, and try and see what the issues are. Why might your customer not pay you on time? Certainly, they may be having financial difficulties. The other question may be, there could be a problem with your product quality. Maybe it's not what they ordered. Maybe you shipped it to them, and it's not working. Or in my case, maybe I provided a workshop to Carly's organization, and it was below standard. She's going to have a conversation with me, and Frank, I think that service just wasn't what our expectations are. So I would need to resolve that issue for her, maybe give her a discount on a future workshop, or give her a free one, something of that nature, and then I could get my monies in. So this aging analysis, together with your DSOs, may tell you it could be a financial issue with your customer. It could be a non-financial issue. It could be just your processing. It may take you also, as an example, 2 weeks to get your invoices out. Well, if with Carly, you can respond. If I have an invoice after a workshop and I don't get it to you for 2 weeks, and your terms are 30 days, are you going to pay me 30 days from my invoice date or 30 days from getting the invoice? I would think Carly might say, well, Frank, I'm going to start that 30 days once I get your invoice. So that will delay my getting cash. But Carly, you're going to do it right on my invoice date, right? So yes, there could be, thank you. There could be an internal system issue in your businesses as well. So that's receivables, both DSO as well as aging of your receivables. We now want to take a look at inventory. If you're product-based, and once again, I suggested even though you may be in a service business or governmental agency, you may be dealing with suppliers for products coming into you. So I think it's important just to appreciate how this is. It's days inventory outstanding, i.e. how many days of inventory do I have in the warehouse, on the shelves, in my store? The calculation is take your average inventory, again, maybe over a year, a couple of quarters, divide it by your cost of goods sold. That's the material, labor, overhead that went into your product. We need to annualize that, so multiply it by 365. So this company, their average inventory is $3.5 million. Their annual cost of goods sold, $53 million. So the calculation will be to take their average inventory, divide it by cost of goods sold, and then whatever your result is, multiply it by 365. Their days in inventory, therefore, are 24 days. In other words, they've got on the shelf in the warehouse 24 days of inventory. Do you want that up or down? I would suggest you probably want to get that down or keep it as low as possible without sacrificing the ability to deliver product to customer. So you do have a balancing act in there. I want to make sure I'm not out of stock, but I want to make sure I don't have so much stock it's sitting there idle. And again, like receivables, if your inventory, let's say your inventory was 100 days, you may have some potential write-offs. Your inventory could be in the food, the chocolate area, so you may have some spoilage impact. It could be also a product that moves very quickly technologically. For example, Apple is talking about and has already started to deliver the iPhone 12. Well, if they had built a lot of iPhone 10s, a lot of iPhone 9s, and they're sitting in the warehouse, when they launch the iPhone 12, that may negatively impact the sales of their older models. So they need to plan their process and do a pretty good job of sales forecasting. So they're balancing the demand for their product with the inventory buildup. If we have excess inventory, I'm going to again use that term write-off. If we've got inventory that is not going to sell, I'm then going to have to write that off. When you hear write-off, please understand that means an impact against profits or a charge against profits, thereby reducing your net income. This metric, yes.
Sorry, quick question too. For companies, I was just thinking around the holidays when a lot of companies are, if they're preparing for higher sales numbers or adjusting for like a certain time of year where you know your demand's going to be up or down. How do you kind of adjust for seasonal changes in demand?
Well, it's a wonderful question because we do face that. So I would anticipate many companies in November, December have had an increase in their inventory. Therefore, their day sales outstanding would be going up naturally. And if that's the case, we can probably explain that. Frank, I gotta bring in 2 or 3 months of inventory to get ready for the sale. I can't afford to miss the sale. Totally understandable. But at least in calculating the DSI, in fact, what you might want to do in that case is do a forecasted DSI for your months of November, December, or whichever months are your high ones. Do a forecast and then say, well, that we're kind of anticipating that. The challenge, though, still will be having the cash available to finance that ramp up. And some companies in retail industry, because of going through some tough times, may need to go out and borrow some cash in order to finance that ramp up. So if that's a forecasted ramp up, given your business condition, that's great. But now we just need to be able to see how we can get the cash to do that. Again, with Moderna, Pfizer, and the other companies working on the vaccine, you can imagine what their inventory is looking like in November and December as they have ramped up. And they have had an incredible pressure on their cash to be able to finance that ramp up in inventory. And in the US and in other countries, what the governments have done is say, look, this is a major health issue. We governments are going to finance you or assist you in financing that ramp up. So there has been a significant amount of funds coming through government coffers to support that ramp up. So wonderful question. Very good question. You do need to anticipate that. Thank you. Any other points in there, Marissa?
Thanks, Frank.
Okay, thank you. All right, the next little piece we're going to talk about is this break-even discussion. What level of revenue do I need to cover my costs? So your break-even point will come up with the revenue level to cover all my costs. Anything you deliver above that will generate a profit. And I'm going to use the example, a couple of years ago, I had the opportunity to purchase a preschool in North Carolina. It was a town north of Charlotte called Mooresville. And any of you that is a racing car buff, Mooresville is kind of the epicenter of cars, racing companies. The big ones are up there. So went in and purchased a preschool. And I wanted to understand what level of enrollment, if you will, and we had children from 6 months to 6 years in our preschool. And I wanted to develop what type of enrollment do we need, at least in the first year of purchasing it, to break even. So I had to examine my expenses. And I looked and I saw, well, we've got about 4 major expenses. Our salary of teachers, their benefits, of course. Rent, we did not own the building, we rented it. Had a director to manage the preschool, her salary, and utilities. These were the key expenses. And what I needed to do was analyze those into 2 categories. What are referred to as fixed costs or expenses, and variable. What do we mean by that? Well, an item is fixed. An item is fixed if in total dollars, that item does not change as my level of activity goes up or down. Let me repeat that. An item is fixed if in total dollars of that item, that total dollar does not go up or down as my activity changes. Example I've got here, probably the best one would be rent of our preschool. Whether I had 10 children, 20 children, 80,000 children, my total rent stayed exactly the same, as did property taxes, as did administrative salaries. So I categorize that as fixed. Variable is the exact opposite. An item is variable if in total dollars, it does change with level of activity. Best example I had was my teacher salaries. As I had more children enrolled, I had to increase the number of teachers. Therefore, the total dollar amount of my teacher salaries and benefit is variable. Food and beverage, we provided a hot meal at lunch. We provided snacks in morning and afternoon. So the total cost of our food and beverage would go up as we had more children. Therefore, I refer to that as a variable cost. So if you're doing this analysis, and I urge you to do it, pick out your big expenses. I wouldn't worry about all of them, but pick out your major ones, maybe your top 3 or 4. And if those represent 70 to 80% of your total expenses, I think this will give you a pretty good analysis. So how do we do this? Before purchasing it, the preschool, I got the financial statement, the income statement from the sellers of the preschool. So I was doing my analysis, and here's the income statement they were working with. Their revenue, $500,000. Now, at that time, they had 50 students, and our tuition was around $10,000 per year, or their tuition was $10,000 per year. So their revenue was running at about $500,000 per year. I then took a look at our costs and tried to break them as best I could between fixed and variable. So let's look at teacher salary. Again, that's variable. The more students I had, the higher my total salaries. The fewer students, the lower the salary. So I consider those variable. I then also, and I'll show you why in a minute or two, I wanted to get my variable costs per unit. Now, in this case, my units were children. I don't know if I want to call them units. So I would take my 320,000, and again, we had 50 students, 50 children. So my variable costs were $6,400 per child. My director's salary, I considered that fixed. They would probably be there regardless of enrollment level. We had a cook, 25,000. I didn't want to call her a chef. If I called her a chef, I would have had to increase salary. So refer to her as our cook. She wasn't full-time. She wasn't full-time. She would come in a few hours before our snack time and leave a little afterwards. Food and beverage, I consider that variable. Rent, of course, as I mentioned earlier, was fixed. School supplies fixed. Utilities, I kind of broke into two buckets. If we were closed for the weekend or holidays, I still had some utility costs. I still had to kind of heat the building or cool it in the summertime. Had to keep the water flowing a little bit. Some of it's variable. So when we were very active, we would have higher electricity, water. Loan interest, as well as insurance, property insurance, casualty insurance, both fixed. So my fixed costs were $297,000. My variable were $338,000. That totals to $635,000. So just going back momentarily, my total costs, were, well, $635,000. I didn't fill this earlier, so sorry about that. So my total costs were $635,000. They were working at a loss of $135,000. Their variable costs were $67.60 per student. So every time they had a student enrolled for a year, it cost them $67.60. And you can see most of that was in the salary. So I tried to break down my major expenses between fixed and variable. Why? I'm going to give you a little formula now. I wanted to get the break-even point for the preschool. How many students do I need just to break even? So I got my parameters up at the top. I've got price, that would be the tuition, $10,000. My fixed costs, again, those were right from my analysis before. There's the $297 of fixed. My variable cost per unit is $67.60. Just from my analysis earlier, there it is. So I brought those forward, and here's your, what I wanted to determine was the break-even point, i.e. the number of students. So your formula is taking your fixed costs, 297, and dividing them by the difference between your price per unit and your variable cost per unit. That would be 10,000 minus your 67.60. That came to 3,240, that difference. That difference is sometimes referred to as your contribution margin or your contribution amount. So when I did the calculation, I came up with a enrollment we needed of 92 students. So at a level of 92 students, I would just break even. I would be delivering enough revenue to cover all of my expenses, both fixed and variable. Now, Frank Abbott is a little bit of greedy. I wanted a little bit more than just breaking even. I wanted to start delivering a profit to return some monies to my partner and myself. So how do I determine that? I use the same formula, but I'm going to make a little bit of adjustment on the next slide. So everything is the same. There's your price, fixed cost, variable. However, I'm saying, all right, I'd like to earn 50,000 next year. And maybe this in the first year of business or first year having owned it was a reasonable expectation, because our salaries, my partner's salary and myself, were not included here in those expenses you just saw. Those were the salaries of my employees. So I'm saying, well, you know, I'd like to have a little bit. I got to pay rent. I got to buy some groceries myself. Quantity is the unknown. So all I did in the formula was add in the profit projection. Add in the profit projection to my fixed costs of 297. So when I added the 297 and the 50,000, and then I divide by the difference between my price and my variable costs, I came up with a enrollment level of 107 students. Actually, it was 107.3, but I can enroll 0.3 of a child, so I probably rounded that up to 108. So at a level of 108 students, not only did I break even, I also delivered a profit. So if you are product-based in your businesses, I think this would be very, very valuable to calculate your current break-even point and then project forward to next year. What will be your break-even point next year? Looking at your expenses, fixed and variable, because that may be a year that we suffer a little bit still, and then you can do a break-even point, and can we expect that to happen in year 2 and 3? This is by units. The last little piece of information, well, what if I'm a service-based business? I'm not selling a product, I'm delivering a service. Concept is very, very similar. And I can do this for my preschool as well in dollars. There's your price, there's your fixed cost. Now, what I want to do is take my variable costs as a percent of sales. Variable costs as a percent of sales. And by going back to that income statement, I determined that my variable costs were running at 68% of sales. What revenue do I need to break even? Here's your formula. I take my fixed costs, which were $297. I divide that by the difference between 1 and my variable cost as a percent, 0.68. And I get a contribution margin, if you will, of 0.32. I divide the 297 by 0.32, and I come up with a dollar revenue of 928,000. So at a level of 928,000 in tuition, I am breaking even. And we can revise this formula a little bit to add in, well, what if I wanted a profit of 50,000, 100,000? I can also come up with a revenue projection for that. I find this break-even analysis, be it product-based or service-based, incredibly valuable, particularly as many of us are going through somewhat of a downturn. What is my break-even point, and is that reasonable? So that is that. The last little thing to conclude, and then we can open it up back to Marissa and Carly. My last opportunity to improve the reputation of us accountants. We've got the accountants versus bank robbers. There were two accountants. They're in a bank to do some business when armed robbers burst in. Some of the robbers take money from the tellers, and a few of the other robbers start to line up the customers, including the two accountants, and start to take their valuables, wallets, purses, etc. While this is going on, while the robbers are doing this, accountant number 1 jams something into accountant 2's hand. Without looking down, they do not want to bring attention. Accountant 2 whispers, "What is this?" Accountant whispers, "It's the $50 that I owe you." So that is it, folks. I'm going to stop sharing and turn it back over to Marissa and Carly.
Thank you so much, Frank. That was awesome. Just to finish up here, we will just dive a little bit deeper. Like I had said earlier, if you guys, missed anything, whether if you had a coworker that, couldn't make it to the recording or couldn't make it to the session, the recording will be on our community site offsite. Completely free to join. You just sign up, and you can also check out any of our past events there, and then all of our upcoming events will be on there as well. And then there will also be a little Q&A with Frank in case you have any questions. If you want to email Frank personally, his email is frank@fabbotandcompany.com. We are also right now offering 15% off when you join offsite to our full-length workshops that are going to be on January 27th and April 15th. Accounting, tax day. We're doing this kind of in honor of tax day. So when you join offsite, you will receive a 15% off code, and that code will be posted on offsite today. If you have any questions, you are more than welcome to email me or Carly with any sort of offsite questions, and we'll be happy to answer those for you. And we are going to introduce offsite. We have a quick little video that we wanted to show you guys. We are really passionate about this community site. We just want it to be a safe place for people, a place where you can ask questions, share your stories, share any comments or concerns that you have, and we just listen and learn. You can interact with instructors there, and we just want it to be a place for community. And it's a community dedicated to fostering the skills, principles, and connections needed to thrive in the new normal. And I will pass it over to Carly now. She's going to introduce the video and talk a little bit more about offsite.
Thanks so much, Marissa, and thanks so much, Frank. I just wanted to share one more thing too before we jump into offsite. just thank Frank for all for your partnership over the last couple of years, Frank. And if anyone here is looking for more in-depth training or work on internal finances, Frank has been a really wonderful resource and partner for Learn It and our clients over the years. For a lot of my personally clients I've worked with. And I've loved partnering with Frank over the years to really help our clients. So if you are interested in bringing finance for non-financial managers training to your organization, please reach out to Frank via email, or you can get in touch with Marissa and I, and we'll connect you directly. But he's just been a pleasure to work with as well. And just to reiterate, the 15% off is for 2 public workshops that Marissa mentioned on finance for non-financial managers. So if you do want to dive deeper, that is a full day workshop, and it's a little more collaborative. There's more time for Q&A. This was kind of just a little nugget. So really, really grateful to have Frank on here. But if you are interested in diving deeper and learning more, we do have that full length workshop, and it's open to everybody. We're happy to share that discount, but the discount code will be available in Offsite, which, as Marissa said, is our new community platform. We're going to have weekly office hours with instructors in there every week. We're going to have Ask the Expert sessions, as well as kind of info on how to use Offsite sessions in there going into the new year. And all of our events for the month will also be themed going into the new year. So a lot of really exciting stuff coming up, and we'll go into that more next week as we wrap up our events for 2020. But I will close us out with a quick video on Offsite. Some of you have seen it before. Most of you are familiar with my face and my voice now, but excited to be launching this and really grateful to have each of you in our community.
Hello, and welcome to Offsite by Learn It. I'm Carly, Community Lead. Offsite is a new online community.
Oh. Sorry, everyone.
Hello, and welcome by Learn It. I'm Carly, Community Lead. Offsite is a new online community dedicated to fostering the principles, skills, and connections needed to thrive in the new normal. It's a place you can go to reconnect with your professional goals and aspirations and find answers by collaborating with a group of intelligent people from all over the world. And now, more than ever, with the crisis affecting everyone in some way, we are all looking for safe, inclusive spaces to connect with each other, to learn new things about the topics that matter most, and to grow together personally and professionally. So whether you are working on your own personal growth, working with technology, working with others, or leading people in teams, Offsite can help. Offsite is organized by topic. So if you're looking for career advice, insights on business, free workshops, or a good book on leadership, it's all on Offsite. And in the spirit of community, we are looking to you to help us shape this platform. We encourage you to engage with your peers and instructors, share your thoughts, and ask questions. The more you put into it, the more you get out of it. We are so excited to be launching this online community, and we can't wait to see you here.
Awesome, everyone. Well, thank you so much. I will put the links to Offsite. I'll put the links to donate to the Canadian Cancer Society in the chat. Again, if today's session was beneficial to you, these sessions are free, but we are giving the opportunity just to donate to the Canadian Cancer Society in support of Frank, in support of our community, and as a way to just kind of keep giving during this time of while we're all on lockdown and we're going into the holidays. So we really appreciate your time and attention. Thank you, Marissa, for hosting today. And thank you, Frank, for an awesome session. Please reach out to us with questions, comments. We'll stick around for the next minute or so if there's any last questions. Otherwise, we can address those in Offsite. Thanks, Dan. Thanks, Shilpa. Thanks, Selma.
Thanks, everybody.